Good afternoon, friends, and welcome. I'll be sharing live trades and results with you. We'll be evaluating how well these trades work out. We'll be benchmarking this against the S&P 500. I'm expecting to be outperforming it every month. Along the way, I'll also be sharing some lessons I've learned about investments, trading, and building wealth. And of course, the mandatory disclaimer. This is for educational and entertainment purposes only. It should not be interpreted as advice. And with that, let's get into it. All right, we're going to catch up on the last two trades. Those occurred right in this area here. Just as you might remember, we had a very strong trade here. It lasted 2 months, gave back some returns. A couple trades also took some losses. So definitely giving some of that gain back. But we're going to focus in on a couple trades. The entry point for this one was as the market was falling, we went ahead and got out. We actually entered in at the end of this day, although we didn't quite get the price we wanted. The price was very volatile toward the end of the day. We got an entry rate about there. The next day, the market dropped, came back up, ran a little bit. And when the market went to this level, we took an exit at the top of that candle. The following day, we're back in, and we took an exit at the bottom of this candle. So we're definitely tightening up the stops, and maybe here's one of the lessons. As you've had a big trade and you're giving back some of the losses, we are going to tighten in a little bit to try and protect some of those gains. So let's head over to our tracking sheet and see how we're doing. All right, I have highlighted the two trades in question, and the first one closed on June 29th. The S&P was around 741. It had actually picked up 1%. On that particular trade, we did a little bit better. We did 1.39%. And that brought our year-to-date return to 28.13. These dark green bars are showing you sort of the darkest of these colors are the top two year-to-date returns. So we definitely, peaked around close to 35%, slowly giving back some of that. But we're tracking right now at this point around 28% compared to the S&P's year-to-date around 9.24. The next trade ended July 2nd. The S&P was 744, and that brought the year-to-date return on the S&P 500 to 9.8%. So pretty good. We're looking at 6 months of the S&P, 9.8%, very good. We took definitely a big loss on that. We took a loss when the S&P was actually going up, so it makes us even more disappointed. That was, I would say, a very bad trade. But that bring our year-to-date down to 27.2. So we're still comparing 27.2 versus 9.8. We've definitely had some interesting trades here, after our very sizable gain. And let's look at our metrics. So, a couple things are really standing out to me. The first one is percent winning trades. We're sitting right around 48%. That's pretty unusual. We're usually closer to around 60. So we're going to keep our eye on that and see kind of what's happening. Beat the market factor looks very solid. We'd like to see that over 1.5. We're at 1.78. And that just means that's how much more we're outperforming the S&P. We'd expect to outperform about 1.5 times, but we're actually doing a little better than that. On the year-to-date numbers, I'm really focusing in on these three metrics: return, drawdown, and downside volatility. And you can kind of compare, it's a great way to compare any kind of strategies, whether it's an allocation of a portfolio, a buy and hold strategy, or how you're doing on your trading. But the S&P is looking at 9.8%. We're looking at 27.2. The drawdown that we've seen this year on the S&P was 6.28%. We saw 6.34%. So when I look at that, I see immediately for the same kind of risk, we are getting a little premium on the return. Downside volatility, same kind of thing. The S&P downside volatility is not too bad, 2.36% versus our 3.67. We definitely see a little more downside volatility. Our drawdowns are pretty close in terms of what we see per trade, but this we have to keep our eye on that because that means this is a little riskier than holding the S&P. But the amount of risk to see what the return is, if we are actually getting a beat the market factor of around 1.5, that seems to be completely in line. If we look at the historical data, we're now sitting at about 5.5 years. I'm just amazed at the S&P in the last 5.5 years. The compound annual growth rate is 14%. It's typically around 10. I always think about when the market gets very hot like this, at some point we're going to see a correction. I will tell you, I don't know when that's coming, but I think it's a good idea to have a plan for that. We're sitting around 24.64% for our compounded annual growth rate over the last 5.5 years. That's super strong. We're happy about that. The drawdown on an annual basis looks even promising, but I think that's a function of timing. I think this drawdown here is more realistic, where during a particular trade, if the markets are tanking, we're going to tank too. And probably a series of trades will pull us down to about the same level that the S&P is down at the bottom. I think the drawdown per year, we're just going to be dependent on when those happen. The yearly drawdown, we're just looking at the end of the year and what's the drawdown. So, for example, in the middle of the year, if there had been a big drawdown of 15%, but we recovered by the end of the year, we're just clocking that in at that -6. But we might have seen a bigger drawdown, and I think it's quite likely we would see whatever the S&P is seeing. In terms of the downside volatility, again, I like these numbers at the aggregate level. We're just a little bit more volatile than the S&P is, but we definitely see the premium return. So we're feeling pretty strong about that. I'm going to switch over to one more chart, which talks about, what is this? What's the bottom line? What does all this mean? All right, this chart shows us what happens to our account balance if we were buying and holding the S&P versus trading. If at the end of 2020, we started out with $100,000, over the last 5.5 years, here's the bottom line. If we were a buy and hold person, we'd have $217,000. That's actually fantastic. The compound annual growth rate and the growth of the S&P over the last 5 years has been incredibly good, better than usual. However, since we're trading, our game is not buy and hold, and our balance at the end is $342,000. That's a pretty significant difference. It's 100 to 200 or 100 to 340. I think that's a big difference, and it shows you and should illustrate every percent in compounding annual growth rate, that you can outperform the S&P. It is a big difference. But here's the caveat. Every percent that you underperform also cuts your earnings too. So trading is a very risky business, and I think you have to be careful when you're doing it, and just watch carefully and track what you're doing, because you need to know if you're outperforming or not. If you were 4 or 5% below the S&P, instead of sitting on 200, maybe you're at 120, and you would have been way better off just buying and holding it. However, that's not our game, and we seem to be able to do a little better than the S&P, so we'll take it. The other point I'm going to make is the buying power here and what a few percent of growth or loss to inflation means. This also means we've experienced some pretty significant inflation. So, we started with 100,000. Our buying power isn't the same. Even though we have more money, even at a buy and hold or a $342,000, the amount that we can buy has been eroded with inflation. So I think it's a good idea to keep an eye on these things. I think every couple percent of growth over the S&P or underperforming the S&P, it's really important to monitor the performance so that you can see how your strategies are performing as well. So that's kind of it for this time. I don't know if you caught on our first screen, we're actually sitting in a trade for a couple days here. We'll have to see how that one turns out on the next time we catch up. That's it for today. How do you think we're doing? Please comment below and let me know how this compares to other investments you've seen. This is for entertainment and educational purposes only. It should not be taken or interpreted as advice. Until next time.